starting with the business justification analysis methods. This group of analysis methods is associated with authorizing or justifying a project or a decision. So what is the purpose of using the business justification analysis method? Imagine you have 4 or 5 projects and you want to select one of them. What are the formulas or what are the financial matrix which you need to use in order to select the best project for the organization to go with? So this is the reason of using the business justification analysis methods. The outcomes of the following analysis are often used in a business case that justifies undertaking a project. So the results of conducting this analysis is being recorded in the business case to justify why you need to have this project in your organization. It's the answer of this question. Now, because this analysis or the results of this analysis is being recorded in the business case, so the business justification analysis methods are not the techniques a project manager should conduct. These activities are being conducted before the project is kicked off, before even developing the project charter. It is at the pre-project phase, and it's usually conducted by the business analyst or the project sponsor team. Now, what are these methods? Starting with the net present value, or known as the NPV. Net present value is the future value of expected benefits expressed in the value those benefits have at the time of investment. Net present value considers current and future costs and benefits and inflation. Now, net present value can be defined as the future value, okay, of the expected benefits minus, okay, the future value of the investment. This is why it's known as the net present value. It is the present value or the total present value of the benefits minus the total present value of the investment or the cost. Now, what is the present value? Okay, it is the value today of a future cash flow. It is the value today of a future cash flow. So think about the present value in our practical life. Imagine you are expecting an income from your project of $100,000 in 3 years. The present value will answer the question, what's the value of the $100,000 after 3 years today? Okay, the value will not be the same. It will be affected by the inflation, by the interest rate, by a lot of factors, environmental factors. So the present value is the value today of a future cash flow. How to calculate the present value? Equals the future value, okay, divided by 1 plus the interest rate to the power A. So PV is the present value, FV is the future value, R is the interest rate, and A is the number of time periods or the number of years. So present value equals the future value divided by 1 plus the interest rate to the power A, and the same formula, but in order to calculate the future value, it equals the present value multiplied by 1 plus the interest rate to the power A. This formula says that the future value, FV, of an investment equals the present value times 1 plus the interest rate raised to the value of the number of time periods the interest is paid, which is usually years. So, an example. Let's assume you will receive $100 in 2 years from now. How do we calculate the present value of this amount? It's a very simple question. Today, we are expecting that we will receive $100 after 2 years, okay? And from the given graph, the number of years is 2, okay? And the interest rate is 8%. So we just need to apply the present value formula, this formula. Present value equals the future value divided by 1 plus the interest rate to the power A. Future value is given in the question $100 divided by 1 plus 8% to the power 2. So the future value or the present value of $100 after 2 years is $86 or $85.9. So there is a difference between the present value today of $100 and the $100 itself after 2 years. This is the present value. Another example, you are performing a comparison between two projects using the present value technique. Project A is expected to make $100,000 in 2 years. Project B is expected to make $120,000 in 3 years. If the interest rate is 12%, which project will you select? Now, this is an example of how a question in the exam will appear or will look like. You have 2 projects and the question is asking you to select the best one from an investment perspective, okay? And you have the future value of each project, you have the interest rate, and you have the number of years. So you just need to apply the formula. Present value of project A equals the future value, okay, which is $100,000 divided by 1 plus the interest rate to the power of number of years, 2 years. So it's $79,000. For project B, the present value equals $120,000 divided by 1 plus the interest rate to the power 3, as the investment is expected for 3 years, so it will be $85,000. When you are using the present value or the net present value, the higher is better. So when you are comparing between 2 projects, you will select the project with a higher present value. So in this case, you should select project B. Project B has a higher present value than project A. Now, what's the net present value formula? It's the sum of the present value of income minus the sum of the present value of cost. Same formula of the present value. However, you need to do the sum of the income present value and do a subtraction for the sum of the present value of the costs. This is why it's known as the net present value. And the same applies for the net present value. When you are comparing 2 or 3 projects together, you will select the project with a higher net present value. The value of all future cash flows, positive and negative, over the entire life of an investment discounted to the present. Net present value analysis is used to help determine how much an investment, project, or any series of cash flows is worth. Net present value is an effective tool to help determining whether a project will be profitable or not. How? If the net present value equals 0, it means that the project will break even. If it is more than 0, it's positive, then the project is expected to be profitable. While if the net present value is less than 0, then the project will lose money. It's not worth investing. Another example, you have 3 projects to select from with the following information. Project A, 4 years life with net present value of $200,000. Project B of 9 years life with a net present value of $250,000. Project C with 2 years life and a present value of $50,000 and a net present value of $180,000. Which project would you select? So we have 3 projects. You need to look for the common given information of the 3 projects. For the first project, number of years and NPV. For the second project, number of years and NPV. For the third project, number of years, PV and NPV. So you just need to ignore the present value here, as I don't have the present value of other projects. You should also ignore the number of years. Why? Because in the formula of calculating the net present value, the number of years is being considered. So you just need to look on the numbers you have. For projects A, B, and C, the highest net present value goes for project B. So the best project to go with is project B. If not B, it's A, and if not A, it is C. A higher net present value is a better choice. Now the second analysis method for business justification and project selection is the IRR, or the internal rate of return. It can be defined as the projected annual yield of a project investment, incorporating both initial and ongoing costs into an estimated percentage growth rate a given project is expected to have. So again, it's the projected annual yield of a project investment. What you are expecting from this project on annual basis. The amount of money the project will return to the company that's funding it. It's how much money the project is making the company. The rate at which the project inflows, and project outflows are equal. This is another important definition of the internal rate of return. It is the rate at which the project inflows and project outflows are equal. The internal rate of return is usually expressed as a percentage of the funding that has been allocated to it. The internal rate of return is the most popular method. Okay, when you hear someone talking about investments, he can mention or she can mention that I'm planning to buy a commercial building for $2 million with an expected internal rate of return of 8%. Okay, that means that he is or she is expecting this commercial building to return back for him 8% of the investment value each year. This is the internal rate of return. And for project selection or business justification, you need to select the project with the higher internal rate of return. So you have two projects to select from with the following information. Project A with a net present value of $120,000 and internal rate of return of 9%. Project B with present value of $80,000 and internal rate of return of 15%. Which project would you select? So by looking at the figures of both projects, and for project A, they have given the net present value and the internal rate of return. For project B, the present value and the internal rate of return. So the net present value with project A and the present value with project B will do nothing for us because we don't have the figure of each one of them for each project. So you need to look at the internal rate of return. Project B has a higher IRR, so you will go with project B. The criteria given for both projects is the internal rate of return, and project with higher IRR should be selected. In our example, it is project B. The third method is the payback period. Payback period is a very simple one. It's the time needed to recover an investment. How many months or how many years do you need to return back your investment? The time needed to recover an investment. So for the majority of the business justification analysis methods, higher is better. For the payback period, lower is better. So the payback period allows firms to compare alternative investment opportunities and decide on a project that returns its investments in the shortest time. When choosing between projects or when choosing alternative methods of doing the project, projects with less payback period are considered, and that makes sense. You need to look for the projects that will return back your investment in the shortest time period. So lower or less payback period is better. Payback period is considered as the least precise of all the cash flow calculations. The reason behind that it does not consider the value of cash inflows in later years and commonly called the time value of money. An example, a project initial investment is $1,200,000 with an expected benefits shown in the table below. What is the payback period? So we have this table showing the expected benefits per year for this project. Year 1, year 2, year 3, year 4, and year 5. The investment was $1,200,000. How many years or what's the payback period of this investment? You can notice that this project will return back the $1,200,000 in 4 years. 500 plus 300, 800 plus 200, 1 million, and another 200, 1,200,000. So the payback period of this investment or this project is 4 years. The last method I will be presenting in this lecture will be the cost-benefit analysis, also known as the cost-benefit ratio or benefit-cost ratio. A cost-benefit analysis is a financial analysis tool used to determine the benefits provided by a project against its cost. So again, it's a financial analysis tool that we use to determine the benefits provided by a project against the costs of this project. BCR, okay, which is the benefit cost ratio of greater than 1, means that the benefits are greater than the costs. If it is less than 1, then the costs are greater than the benefits. The analysis calculations results in benefit cost ratio, BCR, which can be expressed usually as a decimal or as a ratio like 0.7 or 50%. Now, what I want you to understand that this analysis method compares the benefits, the expected benefits, to the costs. So it is a benefit to cost ratio. If it is more than 1 Okay, it means it's a good choice because the benefits are expected to be higher than the costs. If it is less than 1, it means that the investment value or the cost is higher than the benefits. If a BCR is higher than 1, is the project is profitable, and the higher the BCR, the better. So if you are comparing between two projects and both have a more than 1 BCR, select the project with a higher BCR. If it equals 1, it means the project will break even. If it is less than 1, it means that the project will cause the organization to lose money, and it is generally considered as not a good investment. An example on the benefit cost ratio: you are considering a project for the expansion of the organization facilities to increase production. The cost for the expansion work and the equipment would be around $1 million net present value. It is expected that an increase in revenue of $2 million NPV would be realized with this expansion. What is the benefit cost ratio of this project? A very simple question. The cost is given in the question with $1 million and the benefits or the revenue is given with $2 million. You just need to divide the benefits to the costs. So 2 million divided by 1 million, the BCR is 2. So it's higher than 1. The project is profitable. This is all for the business justification analysis methods: net present value, payback period, internal rate of return, and the cost benefit analysis. Even if you did not have any question in the exam about this topic specifically, it's good for you as a project manager or as a project management team member to be aware of the common tools that the business analysts or the project sponsors is using to select the best project.